There's a 19-year-old kid that went on to make $30 million trading this trend following strategy in the matter of like 4 to 5 years is what it's said to be. In this video, I'm going to explain to you exactly how this 19-year-old kid went on to make $30 million trading. I'm going to explain his entire strategy and what that looks like, give you the backstory, and also talk about 3 key things that he said were the most important in becoming a successful trader. If you're somebody that's looking to become a more successful trader, then make sure you watch this entire video. So back in the 80s, there was this famous experiment that was done among 2 traders. One guy was named Richard Dennis and the other guy's name was William Eckhart. And they basically had this bet. And he said that Richard Dennis said, I am betting that great traders are actually made, they're not born. And he basically had this idea that he could take anybody off of the street and he could turn them into a successful trader if they'd follow his mechanical trading rules. And so, long story short, he went out there and he put out a newspaper ad and looked for anybody to come trade with him that didn't have trading experience. Some people were musicians, some people were accountants, some people were from all different walks of life, but none of them had any trading experience. Now, that group of 13 random people were taught a very specific trading strategy, and it was said that they went on to make $175 million in the matter of like 4 years. And of that, one of the most successful traders was this guy named Curtis Faith, who actually ended up making $30 million or so in that period of time. And long story short, this experiment was called the Turtle Traders because this guy, Richard Dennis, basically believed that, hey, if they could train turtles like they did in Singapore, then he could train traders. And so the most successful guy, that 19-year-old kid, went on to write this book later on in life where he explains exactly the commonalities of what he was taught to become the most successful of this turtle trader group. So let's get in, let's actually talk about what was this strategy and how did it actually work and how this guy going to make $30 million. So first things first is this was an experiment, again, done in the 80s, and they were trading all different sorts of things. They were trading commodities, they were trading indices, they were trading Forex, they were trading bonds, they were trading metals. And essentially what they were doing was trading a very simple mechanical-based trading system. That was the whole deal. He knew that trading was this emotional battle, and he knew that if people would just follow the dang rules, then they could become successful. And he also noticed that he gave the same system to several people, and some of the people weren't successful, and some of the people were successful, even though they had the exact same trading system. Well, why is that? Well, it has to do with their psychology, which we're going to talk about in just a second. So what was this strategy, and how did it work? So the first thing was they had to decide on what markets they were going to trade. So number one is what markets were they going to trade? And they only looked for markets that were highly liquid. And so this means that they were not trading small cap cryptocurrencies or something like this, things that had a lot of liquidity, commodities, metals, indices, bonds, these sort of things that had a lot of liquidity. That was the first criteria. The second criteria was in their position sizing. And it said that essentially the way that they calculated the position sizing was based off of the average true range, which I've pulled up here on the screen. It's an indicator, the ATR, you may be familiar with it, but they looked at the 20 period ATR and they had based their position size based off of the volatility of the market. So the more volatile the market was, the larger their stop losses would be, and the less volatile the market was, the smaller their stop losses will be. And I'll show you how this works in just a second. The third thing that they looked for is they actually just looked for some sort of breakout pattern. So this is a really simple trend following system. It doesn't have a ton of rules, but it has very specific rules. And so their entry criteria was basically looking for a price to break above previous resistance or break below previous support. And to give you an idea, what they looked for was a break above the 20-day the high of the previous 20 days. So you can actually slap on this indicator. It's called the Donchian channels. And I just went in here and I put on a 20 length for this. And essentially what they were looking for is anytime they got a candle close at the previous 20 days all-time high, which would be like an example right here, they'd go in and they'd actually enter this trade. Now, today it said that they actually use the 200 period instead of the 20 period. But basically, all they're doing is they're looking for a breakout and they're looking to ride these big trending markets that happen. And that's the whole idea. Now, a couple things about this system. It's very difficult psychologically to trade because the win ratio is really, really low because we're just looking for these big trends. And when we do get those big trends, that's when you make up these, all of the losses that we had previously. So the idea here, again, it's waiting for this resistance to be broken through. It's a breakout trading strategy. And then as far as the last part is when to actually get out of the trade or when to actually stop. And essentially the way that they do it is they'd have a hard stop loss at 2 times the ATR. So if we look here at this candle right here, I'll zoom in here. If we look at this candle right here, right, we got it to touch the upper bound. So this means that this would be an entry. Okay, now if we just come down here to the ATR, we can see that the ATR is about 30. So you just come in here and you'd put your hard stop loss at 2 times the ATR, or like, in this case, we'd put it at 60, right? 30 times 2 is 60. There'd be a hard stop loss there. Now, it was also said that they'd have a 2% account total stop loss. So, if they're trading in multiple trades at a time, if they ever got to 2% drawdown, then they'd also exit the trades. Okay, so that's how that works. Now, the idea is also they would look for these long trending markets to trade into, and they'd also use a trailing stop loss. So the way that they would do that is based on a 10-day low. So I also have another Donchian channels here, and you can see that we're essentially, this is a 10-day. So again, I just went in here and I put in 10. And so we're looking for it to close on the lower bound of this 10 days. So this is the lowest that it was in the previous 10 days, essentially. So basically, it would mean that we'd exit the trade right here, right? We'd enter here, put the stop loss at 2 times ATR, and they'd basically exit here. These were the original turtle trading rules way back in the day, right? So this is, we're talking 40 years ago that they would trade this system, but this is exactly how it worked. Now, for modern day, they've updated it a little bit, but this is how it trades. So let me just show you one other example, and then I'm gonna show you something interesting. Hey, and by the way, if you're finding this video helpful so far, like and subscribe so you don't miss out on other helpful content. And also, if you're a trader that would like to trade more capital, we're gonna show you how we can get you funded $100,000 worth of trading capital or more without ever having to manually take a trade, all doing this with robots and prop firms. So go on over to propfarming.com if you'd like to get funded with more capital in order to trade with. Again, that's propfarming.com. So again, one more time, I'll just show you another example. Essentially, we're waiting for this breakout to happen. We saw that this big green candle happened right here, and it closed actually above this upper bound or above the previous 20 days. And we look at the stop, the ATR right here is at 50. So we'd come in here and we'd put our stop loss at 100. And essentially we would just try to ride this trend, right? And we'd also take a look at the 10 period, and we'd look for it closing below the low. So you can see here that we saw that this happened right here. So essentially we would have entered the trade and we would have exited it right here for just a small little loss. And that's the whole idea behind the turtle trading strategy, or how this guy made $30 million as a 19-year-old kid. Now, besides just the mechanical rules of the strategy, I think the more important thing was what the successful turtles actually did and what the unsuccessful ones did. There was 3 things that the successful turtles did. The first thing was that they didn't care about being right, okay? All they tried to do was they tried to trade the system mechanically as closely as possible, meaning that they didn't care if they were on a string of losers or anything like that. They just traded the system exactly the way that the system was designed to be traded, and they just followed the rules hardcore. And they also noticed that every trade could lose money, and they were actually okay with that. The second thing that the successful traders did was that they avoided recency bias. So a lot of times when we're trading, right, if we go on a losing streak, it's really easy to think that, hey, I've been losing a lot recently, and my recency bias says that, maybe there's something wrong with my trading strategy. And so you decide to change something up, or you decide to stop trading the strategy, or you decide to trade a new strategy, right? What we often call system hopping or strategy hopping, which is a real fatal mistake amongst a lot of new traders. And so the second thing was that they didn't care about recent activity that happened. They looked at it on a bigger, grander scale. And then the third thing among successful turtle traders was the fact that they avoided the future tense. And They didn't know what was going to happen next. And I think that's important for all of us to realize is to make money in trading, you don't need to know what's going to happen next. And actually, some of the most successful turtles, they came out and they actually said that, when they were asked, hey, what's going to happen next in the market from their friends, they just said, hey, I don't know. And they're very honest about that. And they also went on to say that the best way to think about trading is to think about it as the way that insurance companies do, right? Insurance companies know that they're going to make a certain amount of income depending on how many people are on their insurance policy. And then they also know that they have a probability of a claim being paid out. So they know that what is their income going to be? And they also know what is the probability of them having to pay out in the form of claims. And he said the way that you should think about trading is the same way that insurance companies think about their insurance claims and their income. Now, this 19-year-old kid was said to earn like 3 times more than anybody else. And why was he able to do that? And he said that there was 2 things that the unsuccessful traders did. He said that number 1 was that they lacked the concentration in the ability to stick to a trading system. Okay. And again, for all of these reasons that we talked about previously, going on a losing streak or, your account going into drawdown or whatever, they basically bailed on the system. And because of that, they weren't able to become successful. The second thing amongst unsuccessful turtle traders was that they were too concerned with winning and losing. Okay. And he said that he wasn't so concerned about winning and losing or the profit and loss. He was just concerned about, did he execute exactly according to the trading plan? And he realized that losses were an expense in this business. They're part of doing business, and they're an opportunity for him to learn from it. So now you know the story behind the 19-year-old kid that made $30 million. But hey, if you'd like to take this trading strategy or any other trading strategy and do nothing to it, but simply change the risk management rules and see how you can earn up to 3 times more money, click the link on this video that's showing up right here. It's a simple risk management strategy that I promise you will blow your mind. It can make you more money than changing anything else. Go ahead and check that out right now.